Hello, everyone. We're here today to talk about passive real estate appreciation in Calgary. Now, passive appreciation is one of the 4 key components that make up any real estate investment anywhere in the world. And we're going to talk today about passive appreciation in the Calgary real estate market. I'm going to break down 2 key locations within the city that are massive pieces of infrastructure that are going to give investors the best possible chance to maximize their returns with respect to passive appreciation here in Calgary. Then I'm going to take you through a case study where we'll look at the actual numbers so you can see the impacts that are possible if you get even just a little bit of passive appreciation happening in an investment of yours. Would you like to know more about it and what we have in store? All right, let's jump into it. Okay, well, look, before we get too much further into all of this, I think we have to talk about the elephant in the room here, that Calgary hasn't really had any passive appreciation in the last 5 or 6 years. Our market has actually been a slightly depreciating market where our prices have actually come down over the last few years. This is outside the norm of most real estate markets, but Calgary has had to live through this. And so the other 3 components of a deposit or of an investment return have had to stand out and carry the weight. Now, but what we'll look at, because I do feel that Calgary is a very buy low opportunity right now with low downside risk. I do feel that we will see passive appreciation again one day here within our market. So we're going to show you a little bit about which locations in Calgary can provide investors the best opportunities to realize passive appreciation. And then we will also take a close look at an actual case study. So what I'm going to do both of those things is just share my screen with you here right now. And I'll take you through some of the things that I want to show you for this. So the first thing I want to talk about is the Green Line LRT. We had another video about this a few months ago, but this is the largest piece of infrastructure that our municipality has ever undertaken. It's $4.9 billion. We've just had the first phase of the Green Line LRT approved through council. It's going to go from Highway 1 up here in Center Street all the way down here to 130th Avenue in the southeast. It's going to run through downtown. It's going to cross underneath Deerfoot and then head down through into the southeast. Now, the reason why an LRT is so important for passive appreciation is that it's a public piece of infrastructure that is bringing billions of dollars of investment to make it easier for consumers to get around. So what this means is that if your tenants are living in your property that is close to an LRT, they may not need to have as much of an expense for, say, a car or other ways to get around. They've got more options to get around because they can take the LRT. So if they don't have to spend their money on cars, they can afford to spend more money on rental, on their rent payments, which means that you can generate greater rates of return for property that's nearby to there, which is going to make them more valuable, which means you're going to see a lift in the passive appreciation. So that's why it's important to invest in a location where other people, like a major piece of municipal infrastructure, other people are spending money to improve your location for you. So you can see that here with the stations along the Green Line LRT. We did another video on this, and perhaps one day we'll take a closer look at some of the stations along here and what they're actually going to mean for investors. But the Green Line LRT is certainly something for investors to consider if you're looking to maximize your opportunities for passive appreciation. Now, the other one I want to talk about is the ring road. So we talked about an LRT. Now we're talking about for cars to get around there. We're currently in the process now of finishing up the ring road, going all the way around the city. We've got 2 segments of the ring road that are being built out right now. The first one is the West Calgary Ring Road, which is broken up into 2 different phases. You can see that here, which is basically Highway 1 connecting through to Stony Trail. That's the northern section of the West Calgary Ring Road. And then the southern section goes from Highway 1 right up beside Canada Olympic Park to connect through here to Highway 8 and Glenmore Trail, which brings you down to the second component, the second major phase of the completed ring road that we're doing right now, which is the Southwest Calgary Ring Road. We've just had a major portion of this open up just at the beginning of October. It's fantastic. We're going to talk a little bit about why this is so important here in a minute, but this will connect you all the way down here to 22X and eventually over to the existing ring road that has been in place here for a few years. So why is this ring road so important and what's going on over there? Well, I want to talk about the Taza development. So the Taza development is on the Tsuut'ina First Nations land. It's a $4.5 billion piece of private infrastructure where they've got shops here. There's a Costco that's already in place. They've got an entertainment venue, a resort that's in here, a mixed-use development, an outdoor mall is being contemplated in this. So this is a fantastic development, one of the largest First Nations developments anywhere in North America, and it's happening right here in Calgary, which is very exciting. But when you look at what these two things can mean together, a brand new ring road and the Taza development taken together, there's great potential for passive appreciation in the communities that can immediately benefit from these two major pieces of infrastructure. So communities like Cedar Brae, communities like Oak Ridge, communities like Braeside, communities like Woodbine, all of them have been kind of tucked away in the Southwest there for years. And now they're going to get an opportunity to shine because of these two major pieces of infrastructure that contain very little residential real estate components within this. So anybody who's working here is going to have to get there, and they can take the ring road to do it. And they may want to live close by in one of those communities that we were talking about. So what we're going to dive into now is actually look at a case study for a deal. And this is for a property that is located right nearby the ring road here. Just pull this up here. So you can see here, this is where the deal is. This is a deal that a client of ours did earlier this spring. A very shrewd investor. This girl, young lady, went and purchased a nice little investment property right near where the ring road is and right near the Taza development in a community that has very little rental supply over here in Cedar Brae. And so that's going to make up the case study that we're going to look at for our deal here. So let me take this, and then what I'll do is I'll just show you a picture too, because that makes it all the more real. So this is just a little bungalow here. Not going to talk too much about the property itself. We'll save the interior for active appreciation when we talk about renovations that you can do to add value to properties. But for right now, we're talking about passive appreciation, which means buying in the right locations where other people are spending money to improve your location for you. So what we're going to do now is look at my favorite spreadsheet, which is my deal analyzer tool that we've made that we help to show clients how your returns are going to come together. So this is a $375,000 property. It's going to require a renovation of about $25,000 here. We'll show that here in a moment. This can be a busy spreadsheet, but for right now, don't worry about a lot of the numbers that you can see here. We're going to talk about debt service. We're going to talk about rental income and operating costs in other videos when we talk about the other components of a real estate investment, like active appreciation, mortgage paydown, and net cash flow. But today, all you really need to look at is the growth rate. So in here right now, I've actually just did this before. The current rate that I'm using is 0.5%. That's the growth rate that I include in the models that I'm doing. It's lower than the consumer index for inflation here at present. I do feel it's a safe number for long cycle economics in when you're looking at a real estate investment in Calgary. It's not all that high. There are other markets in Canada that have achieved incredible rates of passive appreciation over the last few years. But you can see here the deals still work in Calgary at appreciation rates of less than 1% right now. At 0.5% appreciation, it basically means that your $400,000 house after your renovations have been completed is going to be worth about $10,000 more after a 5-year period. So all of that means is that the value is appreciating by 0.5% each successive year, that little bit extra. And that you can see here under the asset value column for the deals here that we're looking at. So that can show you what happens there. The overall return after 5 years, well, your $106,000 investment, which is your down payment plus some renovation capital for this particular deal. Not all deals require renovation capital, but you're looking at 20% down plus a $25,000 renovation amount and a little bit of closing costs for legals. So you're all in terms of cash for $106,000 for this case study. And after a 5-year period, when you look at all the factors of this investment taken together, you'll have an estimated 5-year return of approximately $87,000 for a 12.75% year-over-year return here. And that's at a 0.5% growth rate. Now, if you double that to 1%, on this, you'll see that now your asset value is increasing not by $10,000, but a little over $20,000. You're nearly doubling your money here at $97,000 total return after a 5-year period. Your annualized return is up here now near 14%. Now, if you double that again to 2% that we were looking at here prior to that, well, now you've more than doubled your money here. Your $106,000 equity component of your deal is now worth approximately $118,000 with an overall return in the mid-teens, 16% or so. And if you got really crazy and did what some of the other markets in Canada have been able to achieve, these are unsustainable growth rates over a long period of time. If you're investing just for passive appreciation, you have to be careful not to speculate, which is buy something with the expectation that the values are going to go up. Because if they don't go up and you don't have the other components of your real estate investment working for you, you can be in trouble. But let's just look at what would happen if we went to 5% on our appreciation rate here. Well, now we're really talking. Your $106,000 investment is more than doubled for an overall return at $188,000. You're up in the low 20s now for a year-over-year percentage of return. And in many markets in North America, they've observed these rates over the last few years, and some of them have even gotten crazier, up to say 7% or higher than that over a 5-year period. And now you're talking really incredible rates of return here that you've been able to get. Now, these aren't typically sustainable. Markets do go through cycles here in Calgary. I do feel we're at the bottom part of our cycle, the beginning part of it, the buy a low time. And so I'm using 0.5%. We're back down to reality here, back down to earth with our numbers here now. You can still have a double-digit return on these. You can still do very well with it. And you'll be able to see the impacts that, or how our market is good for investors in terms of the other components of a return when we do some of our other videos. So I hope you've enjoyed that here today and seeing the impact of passive appreciation on a real estate investment here in Calgary. I'm very much looking forward to talking about active appreciation, how investors can invest in terms of a renovation into a deal to make it that much more exciting and actively appreciate it. Also mortgage pay down, getting the right type of debt financing on a property to own it for a long term. And then lastly, maximizing your overall positive cash flow, the amount of rental returns in excess of any of the costs that you have to deal with to have that additional income stream working for you every month. Looking forward to talking about that with you too. So I hope you enjoyed the video here today. Have a wonderful day and happy investing.